What is the tax deduction? I get that question a lot, especially around tax time. If you're a small business owner, if you just started a small business, or maybe you've had a business and you never really found out what a deduction is, you're just kind of winging it. Today, this episode's for you. We're going to talk about what a tax deduction is, where do you start when trying to find deductions, and I'm going to give you some examples of the most common deductions for small business owners. Before we start, I just want to say my name's Anthony Brister. This is the Wealth Planning Podcast with Brister Law. We are doing end of year tax planning meetings right now. So if you want to schedule a free discovery call to see if we're a good fit, go to www.bristertaxlaw.com. Schedule a free discovery call, ask about our comprehensive or end of year tax planning meeting. This meeting, we're going to help you find the deductions, figure out if you're actually protecting your assets, if your business structure is right, make sure you're in compliance, but then also find these deductions and make sure that you are being as tax efficient as possible and paying the right amount of taxes. So go to bristertaxlaw.com, schedule that discovery call, and ask about the comprehensive end-of-year tax planning consult. So what is a write-off? What is a tax deduction? Well, all a tax deduction is it's a reduction in your taxable income. Today, we're going to talk about really business owners. Now, for you W-2 or investors, there are things like the itemized deduction and standard deduction. I'll probably do another video on those types of deductions. And then your more general personal deductions. Today's episode is strictly about what are business deductions, really. First off, a business deduction is not a dollar for dollar return. So if you're spending $10,000 on a vehicle or any other type of deduction, don't expect to get a $10,000 refund. I like to think of a deduction as a discount at my tax rate, or like a coupon, right? So if you're at a 20% bracket, you're getting 20% off that $10,000 business deduction. Let's go into an example. I think that probably makes better sense and the numbers are better. So Bobby is a W-2 employee. He makes $100,000 a year. He's at a 20% tax bracket, no state income tax. So $100,000 a year, 20% bracket. Bobby's going to be paying $20,000 in taxes a year, right? Well, let's say Bobby started a side hustle. He's making $100,000 in that side hustle, and he comes up with $20,000 in deductions. Well, we take that $100,000 that he makes, subtract that $20,000 from the 100, he's left with 80. So Bobby's paying taxes on that $80,000. So at a 20% bracket, Bobby's paying $16,000. You can see on the $20,000, Bobby's saving $4,000 in taxes, but he still had to pay that $20,000. So he spent it on maybe supplies, inventory, things like that, cell phone, internet, you name it. However, he didn't get that full $20,000 back. Economically, he's better off $4,000 because he didn't have to pay that $4,000. So, just again, to be very clear, a deduction is not a dollar for dollar return. It's a reduction in your taxable income, which in turn is like a percentage of your tax bracket to that expense. Let's take a step back. So what qualifies as a deduction? Well, the IRS has section 162 that says your expense needs to be ordinary and necessary for your business. Now, that's pretty vague. Really, it is dependent on your type of business. personal effects, things like that. Probably not going to be a business deduction. However, there are things that you can deduct that might seem personal if used for your business can be deductible. I think of it again, it's really ordinary and necessary and reasonable in the pursuit of income. The IRS has regulations, there's court cases, things like that of things you cannot deduct. But really, it really is dependent on what type of business you have. So my NIL college athlete is going to be able to deduct something different than my scuba diver teacher, right? Or me, a tax attorney. So we look at your business, look at your field, see what's relevant, what's needed, what is required for you to make money in that field. And then typically, if it is that case, you should be able to deduct it. Now, for bigger items, really we're thinking of real estate, large machinery, equipment, electronics over a certain amount. Those items you might not actually get to expense all in year one. For real estate, we're going to depreciate. For those other items, we're going to amortize, which means we're going to take that deduction and that expense over a period of time. So, you still get a deduction for those larger expenses, but you might have to take it over a period of time rather than in that same year where typical deduction, you get that benefit all in that same year. Lastly, we'll talk about, I think really, again, is the need for tax planning and also keeping track of the deductions. So first off, let's talk about keeping track of the deductions. If you are a business owner, you want to have a separate bank account. If you have some type of entity, you want a bank account in that entity's name where you're tracking all income and expenses. I personally like using Quickbooks to track my income and expenses. Quickbooks allows you to feed in your bank account, classify expenses, income, and then generate reports rather easily. If you guys want to check out Quickbooks, I've got a referral link down in the show notes here. Feel free to check it out. You get 3 months, I think, at a discount. Otherwise, you can use Excel. The last thing your accountant, CPA, or whoever's doing your taxes wants, so at the end of the year, are a bucket of receipts and or bank statements with no type of context whatsoever. So this plays into tax planning, whether you hire a professional to do tax planning with you to be strategic, or you're doing it yourself, doing the research and keeping tracking of the expenses. You want to compare your bank statements and those deductions and give context to your accountant. So if you're using QuickBooks, this is by classifying the deductions, the expenses, and also the income. If you're using something like Excel, again, keeping a general ledger, but then classifying that further down into a profit and loss and getting line items of certain expenses. So really, again, it's important to keep track of those expenses. You want to be able to substantiate it if you do get audited. So keep those boxes of receipts, but don't hand it to your accountant. Give your accountant a clean line item statement of what certain expenses are. We've got really the best starting place, I think, for people is to go look at the Form 1040 and Schedule C. If you guys want to shoot an email over to admin@bristertaxlaw.com, we can send you that form and also an Excel spreadsheet of the Schedule C expenses. Schedule C is for those who are self-employed who haven't made an entity type election. The IRS has on your personal form on that 1040 list of expenses that you can take generally. And again, you should be hitting all of those items or close to it if it's relevant to your business. Those are expenses that they're going to say do qualify, right? As long as it's reasonable. So go to Schedule C if you don't have any idea whatsoever, and that's a good starting place. Next place I say again is have a tax planning meeting with a tax professional. Lastly, I'll give you kind of a list of my top deductions for business owners that I think, again, are personal expenses. But because you have a small business and you're using these items in your business, now you're able to deduct at least a portion of them. We call that personal conversion expenses. So things you're already spending money on, but because now you have a business and you're using it in your business, you're able to deduct it or deduct a percentage of it. So the first off, cell phone, right? I'm making business calls. People are calling me, texting me. I'm looking things up on my phone. I'm shooting content on my phone. I'm using that. As long as you're using it more than 50% business, or if your spouse has a personal line or you have some other type of personal line, you should be able to deduct your cell phone. And if not, at least the percentage that you do use it. Second up is rent, mortgage, or your home office, and or both. If you're paying rent to somebody for business space and you're using that for business, you're going to be able to deduct that. Now for mortgage, right, you're not going to deduct the principal amount, but definitely the interest. Home office, if you're using your personal residence, at least a spot of it, you should be taking the home office deduction, whether it's simplified or the traditional method. Make sure to talk to your tax professional about those two different options. I'll probably make another video too on that soon. But if you're using your personal residence for your business and you have a specific place for that, you should be taking the home office deduction. Third up is vehicle expenses. So we've got mileage or the actual method. Again, another video coming soon about that. Keep track of your mileage or your business use of your personal car. Most people are running errands, even if you're not using it 100%, you probably have some kind of mileage or business use of your vehicle. And same thing with that, the car insurance as well. Make sure to appropriate whatever percentage is business use versus not. But again, we want to be taking that. Utilities, we talked about home office. Sometimes utilities, just you don't keep track of them or you forget them. So you want to pay and deduct your utilities if it is an exclusive business use. If we're talking about your home office, we want to prorate that to the appropriate amount. Electronics, everyone's using their laptop, right? Computer. We got a tripod, things that you're using for your business, and you need to use it in the regular course of your business. We want to deduct that or amortize those expenses over time. Legal professional fees as well. So you're paying your accountant or your tax attorney for tax planning, strategy sessions, things like that. Those are all deductible expenses. Also, your startup cost depends on whether you make a profit or not in your first year and how much those startup costs are, whether you take that in the full year or amortize over time. But again, those are all still deductible. And lastly, we've got meals. Currently, those are only 50% deductible. But if you are eating meals with business partners, colleagues, in the pursuit to make a profit, we want to deduct at least 50% of those costs associated. Because again, every deduction that we get, we're getting a discount at our tax rate, which in turn reduces how much we are paying in our taxes. So that's what a tax deduction is. Ask yourself, is this ordinary, necessary, and reasonable for my business? Don't go look at TikTok for what a tax deduction is first, right? Or believe everything that you see about people writing things off. If it doesn't feel right, if it makes you tingle a little bit, you might be being a little too aggressive. Always talk to a tax professional if you're not sure about something, because penalties and interest, if your deduction gets disallowed, can actually really, really hurt what you're trying to accomplish, and even overshadow that deduction that you would have gotten anyways. My name is Anthony Brister. We're with Brister Law Firm at bristertaxlaw.com. Go schedule a discovery meeting. We've got about 2.5 months left of the year. Don't wait until next year to do tax planning. Be proactive. Reach out, ask for a comprehensive consult, and let's start saving money today. Thank you.